You've got some money saved, maybe a few £100, maybe a few thousand. It's sitting in a savings account. You feel pretty good about that. Responsible even. But here's the thing, that money is almost certainly losing value right now, every single month, and most people have no idea it's happening. This isn't about doing something risky, it's about understanding why the safe option might actually be the most dangerous one of all. And by the end of this, you'll know exactly what to do instead, including the one account type that most UK savers completely ignore. Let's talk about what's actually happening to your cash savings. Right now, the best easy access savings accounts in the UK are paying somewhere around 4 to 5%. That sounds decent, right? But inflation has been running hot. And even when it cools, the long-run average sits around 2 to 3%. So after inflation, your safe savings account might be returning you 1 or 2% in real terms. That's before tax. If you're a basic rate taxpayer, you've got a personal savings allowance of just £1,000 a year. Beyond that, HMRC wants their cut. Suddenly your safe savings account isn't looking quite so safe. Here's a way to think about it. Imagine you had a bucket of water. Every month you add a little in, but there's a small hole in the bottom, not huge, just slow and steady. That hole is inflation, and most people spend years pouring money into that bucket without ever noticing the leak. Now, over 1 or 2 years, that hole barely matters, but over 10, 20, 30 years, the difference is enormous. Cost is difficult. A study by Barclays found that UK equities have outperformed cash in roughly 9 out of every 10 rolling 10-year periods since 1899. 9 out of 10. That's not a guarantee, nothing in investing is, but it's about as close to a reliable long-term pattern as you'll find in finance. So the question isn't whether you should invest. The question is why you haven't started yet. Right, let me tell you about two people, both 25, both earning £30,000 a year. Sarah puts £200 a month into a cash ISA earning 4%. James puts the same £200 a month into a stocks and shares ISA tracking the global stock market, historically averaging around 7 to 8% annually after inflation is stripped out. Fast forward 30 years. Sarah has roughly £139,000. Not bad. James has somewhere north of £240,000. Same money, same monthly contribution, just a different bucket. That gap, over £100,000, isn't down to luck, skill, or some secret investment strategy. It's down to one decision made at 25. The uncomfortable truth? Most people are Sarah, not because they're bad with money, because nobody ever showed them the alternative. So what is the investment? It's a global index fund held inside a stocks and shares ISA. That's it. No stock picking, no watching the markets every morning, no needing to know what a PE ratio is. An index fund simply tracks a basket of companies, usually the largest businesses across the world, and your money rises and falls with them collectively. The most widely held example in the UK is something like the Vanguard FTSE Global All Cap Index Fund, which gives you exposure to thousands of companies across dozens of countries in a single fund. The ongoing charge is around 0.23% per year. For every £10,000 invested, you're paying about £23 in fees annually. Compare that to an actively managed fund, where fees can be 1.5% or more, and the majority of active fund managers still fail to beat the index over the long run. Now, the ISA wrapper is crucial here. Your ISA allowance is £20,000 a year. Every penny of growth inside that account is completely free of capital gains tax and income tax. Forever. HMRC gets nothing. For most people, that's the single most powerful tax advantage available to them, and it's free to use. In terms of platforms, Vanguard UK is brilliant for simplicity and low cost if you're just starting out. Trading 212 offers fractional shares and a clean app experience with zero platform fee on their ISA. Hargreaves Lansdown costs a bit more, but has excellent research tools if you want to explore further down the line. All three are FCA regulated, and your cash is protected up to £85,000 under the FSCS. Here's exactly what to do, and this genuinely takes less time than most people spend deciding what to have for lunch. Step 1. Open a stocks and shares ISA. If you want the simplest possible experience, go to Vanguard UK's website. It takes about 10 minutes. You'll need your national insurance number and a bank account. Step 2. Choose your fund. If you're a complete beginner, the Vanguard Life Strategy 80% Equity Fund or the FTSE Global All Cap are sensible starting points. They're diversified, low cost, and designed to be held for the long term. Step 3. Set up a direct debit. This is the most important step. Automate it. Even if it's just £50 a month to start. The habit of investing regularly, regardless of what the market is doing, is called pound cost averaging, and it's one of the most powerful things a beginner investor can do. When markets dip, your £50 buys more units. When markets rise, your existing units are worth more. You win either way over the long run. Step 4. Leave it alone. Seriously. Don't check it daily. Don't panic when it drops 10%, and it will drop at some point. That's normal. The investors who build real wealth aren't the ones who time the market perfectly. They're the ones who stay in it long enough for compounding to do its job. One final thing. If your employer offers a workplace pension with matching contributions, max that out first before your ISA. That matching is free money. A 3% employer match on a £30,000 salary is £900 a year you'd otherwise be leaving on the table. Don't leave it on the table. So here's what we covered. Cash savings feel safe, but inflation quietly erodes their value. The numbers don't lie on that. A global index fund inside a stocks and shares ISA is the single most accessible wealth-building tool available to people in the UK right now. And getting started takes about 10 minutes and as little as £50. That's it. No secret strategy, no timing required, just starting. If this was genuinely useful, subscribing is the best way to catch the next video, because next up, we're looking at exactly how much you need to retire early in the UK, and the number might surprise you.